I give up a love found, wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? Said you loved me.
The World Cup kicks off in Qatar in late November. Well, alcohol is not illegal in Qatar. There is zero tolerance for drinking in public, and being drunk in public is a crime, But the World Cup may still provide a big boost to the alcohol industry as the games extend over a more than 3-week period. You can't drink there, but you can drink it if you're watching it elsewhere, I suppose. Saz has the take on all of this.
Yeah, focusing in or locked in on beer here to kick off this week. And we had recently talked to, just last Friday afternoon, AB InBev CEO Michel Ducaris came into our studio, talked about the outlook for beer, but most importantly, his enthusiasm around the World Cup. Take a listen.
We are activating 70 countries. In the years that we have FIFA, usually our volumes go up between 0.7 and 1% for the year.
Nice boost.
And the tournament is 3 weeks, but it's global. So numbers from FIFA say that like 2.53 billion people watch the games globally. There are celebrations in each and every country. We'll be activating in 70 countries with the local brands and local passion points, but also with Budweiser, which is the official sponsor of FIFA World Cup Qatar.
So if you can't get hammered at the actual World Cup, if you're watching it in various other places, you can drink your Bud Light and Budweiser and enjoy it. And I think that's what Michel was saying there. Look, we have all these other activations across the country, probably some promotions. We could see a pretty big uptick in beer volumes as a result of this event. And it comes at an interesting time. Some new data out by the NBWA, the Beer Purchasers Index. There is this thing. This thing actually does exist. And
The NBWA.
yes, yeah, is it actual?
Not to be confused.
I saw where you're going. But this has now fallen for 5 straight months in a row. What does this mean? It means beer distributors are starting to order less beer for 5 straight months in a row, and they blame economic slowdown and poor weather in certain parts of the world. But something to keep in mind, maybe the World Cup will help offset this key trend that has started to take shape. My take is this: overall, I was really surprised by this AB InBev quarter, not just because we got Michel into the studio. There I am. Wow, is that a full calorie Bud? I don't do full calorie Bud, guys. I'm a Bud Light guy or a Bud Light Platinum, more alcohol in the Bud Light Platinum. Nonetheless, surprised by that quarter. They pushed through a good number of price increases, and volumes were still up close to 4%. In the beer industry, if your volume is up 4% in price increases, that's pretty darn good.
Metaverse size clearly has different tastes.
Yeah, clearly, right.
How to train your algorithm, how to train your avatar, rather.
I like that take on no public drunkenness in
Yeah.
Qatar.
Good.
You're in trouble.
No SantaCon over there, right?
Exactly. That was immediately where my
No
brain
Shrek
went.
parties.
I have to tell you, no SantaCon.
You're not a full calorie Budweiser guy, right?
I'm not a beer guy, actually.
Oh, we played golf over the weekend. Yeah,
did.
yeah.
You did. No beer.
I started the day with a Bud Light.
I had a transfusion.
Yeah, a transfusion.
Sorry.
So good.
I had, early.
And everybody should know Brad also cranked one out like 300 yards, so hat tip to you.
You know, it was the swing juice.
It was the swing juice.
That's what it came back to. That full calorie Bud
Yep.
that I didn't have. Guys, coming up, we're going to speak to one strategist that says recession from Fed rate hikes will eclipse the impact of midterm elections. That's next. It's actually 324.
영화 속 상상의 세계를 CG로 만들어내는 슈퍼바이저 제갈승입니다. 완성된 CG를 생동감 있게 보여주기 위해 가장 중요한 요소가 화질이라고 생각합니다. A 화면보다 B 화면의 컬러 표현이나 쨍한 밝기 때문에 공룡이 더 역동적으로 보였어요.
Welcome back to Yahoo Finance. I'm Brian Sazza here with Julie Hyman and Brad Smith. A big week ahead for investors with the jobs report and Fed decision looming. Earnings season will roll right along too with key results from Starbucks, Pfizer, and DraftKings. Right now, markets taking this, well, not all in stride. We're seeing all three major indices down so far to kick off this week as investors eye some new COVID restrictions and lockdowns over in China. Now here's what's on tap this hour. Eyeing the midterm elections, Yahoo Finance contributor Kevin Surley joins us as the action picks up in D.C. ahead of next week's midterms. And in the hot seat, Unilever CEO Alan Jobe stops by as his company feels pressure from activist investor Nelson Peltz and a major product recall. And hold the tuna. Subway sees a sales recovery on the back of new sandwiches and ingredients. We'll talk with Subway's North America chief, Brad. Try to tap that one, my friend.
Yeah, keep the tuna. Our guys checking in on the major averages here. Too many inside jokes there. But anyway, the Dow Jones Industrial Average down right now by about 0.7% out of the gate this morning, about 31 minutes into the session. We're also seeing the NASDAQ Composite. That's lower on the day by about 1%. And you're taking a look at the past 3 months, but let's also just take a look as we round out this month as the month to date comes to a conclusion here. Over the month of October, you're seeing that the NASDAQ Composite has held on to gains of about 3.8% in what's been a good month in aggregate here. And so ultimately here, we'll see how things end out on the month. And then the S&P 500, you're seeing that also net positive over the past 21 days that this is pulling in. I don't know why we're not getting the full scope, but anyway, we are down on the day by about 0.8% here. Briefly taking a look at some of the sector activity as well. You've got more laggards. Actually, all of the S&P 500 sectors were in negative territory earlier. We do have two that have trickled into positive territory, and surprise, surprise, energy is one of them. It's up by about 0.9%, flat just barely to the upside right now. You've got materials that's up flat, but to the upside by about 0.1%. With that, I'll toss things on over to you.
Interesting. The energy is continuing that huge run it's had this year and for the month of October. Let's zoom out now for a global look at the economy. Investors have turned cautious after the disappointing release of China's manufacturing and non-manufacturing PMI, both unexpectedly contracted in October, pointing to more economic headwinds ahead. This as China continues to grapple with COVID-19 lockdowns. We mentioned earlier today that Disney Shanghai also shut its doors to comply with COVID-19 prevention measures. Our next guest warns that China's economy will not grow fast enough to compensate for the boost in export demand it saw from stay-at-home orders during COVID. Joining us now with our insight is Wei Li, BlackRock Global Chief Investment Strategist. Thank you so much for being here. Appreciate it.
Thanks for having me.
So as we look at the China situation, we are still seeing lockdowns there, a renewed wave of lockdowns seemingly. At the same time, the economy is sort of struggling to break out. So first of all, I guess, when do you see the lockdowns maybe starting to end? And secondly, even when they do, what happens with the economy there?
I think it's really important to recognize that there are some structural headwinds to growth right now in the case of China. So yes, of course, the zero COVID policy has weighed down on growth expectations so far this year, but it's not just zero COVID policy, it's also export drivers that have been such a big contributor to China growth during the COVID pandemic period that is now fading away as the rest of the world switches back on. So as the export drivers kind of fades, actually that represents a structural kind of headwinds to China growth, which is why we're forecasting just slightly above 3% for this year, and higher than that, of course, next year as China reopens, but not very high. So we're not going to see a V-shaped rebound in the case of China.
Should investors just avoid investing in China at all right now?
I think the tactical and the strategic case for investing in China right now is challenged because of this also focus from not just growth to broader issues like national security, all of that representing a bit of a headwind for structural growth, but also in terms of how that headline growth can translate into corporate profitability, which is why earlier on in the year we downgraded China from overweight to neutral, and actually currently strategically there is a underweight allocation to China government bonds because the yield pickup attractiveness versus US government bonds has been eroded away as we now get paid by holding US government bonds.
Are we just not going to see any of the kind of tit-for-tat tariffs that we had seen during the US-China trade war over the past couple of years and even going into 2020, waiting for some type of resolution on where that would move forward? Or are we just not going to have those conversations reemerge and actually for it to get worse before there's any inkling that it may get better?
I think it's very optimistic to hope for a resolution around the trade war and tit for tat between US and China. In fact, if anything, we have seen acceleration of some of that geopolitical tension. So thinking about the focus on chip manufacturing, thinking about the broader kind of decoupling and moving further apart of the spheres of influence between US and China. So I think that is going to be the base case underpinning our structural kind of expectation on the geopolitical front. And for investors thinking about investing in China from a global portfolio perspective, we need to think about what that means from a risk premium perspective when we construct portfolios.
Let's talk about portfolio construction with regard to the US as well. As you mentioned a moment ago, we're now finally getting paid to hold US bonds, which is an experience we haven't had in a while. In fact, the US Treasury website has been crashing on occasion as retail investors try to get on there. At the same time, obviously, there's a puzzle here for the Federal Reserve as it is raising rates. What is your rate outlook here in the US? What are you expecting to hear from the Fed on Wednesday?
Well, I think the 75 bips of rate hikes is a foregone conclusion that will happen. But what really matters is how far rate hikes can go, and also for how long that will stay, and also what that means for growth, right? So earlier on in the segment, you talked about the October rally. We believe the October rally in risk assets is really on shaky grounds because markets previously were looking for a dovish pivot from the Fed, and then they were looking for a pause from the Fed, and now markets are getting excited about just the pace of rate hike decreasing, which of course it will, because you cannot keep hiking at 75 bips per meeting. So it feels like markets wants to see some positive development in terms of dovish message from the Fed, but really we're not at that juncture yet, because if you look at core inflation, it's still very, very sticky from last week's core PCE, for example, still really quite persistent. And at the same time, the focus of the Fed is really solely on the politics of inflation. With inflation where things are, the mandate is to fight inflation at all costs this year. So we believe that rates will continue rising. It will peak at 5%, and not to understate that. That's a very, very restrictive territory. In fact, where we are now at 3.25% is already restrictive to the economy, right? So our belief is that in this current supply constrained environment, the Fed is going to have to engineer a recession in order to bring down inflation. Our assessment is that if they were to want to bring down inflation to 2% reasonably quickly, it represents a 2% shock to the US economy in 2023. It also represents 3 million additional people out of a job, pushing unemployment rate to 5%. So this is the sort of the very heavy and high cost of inflation fighting in the current environment shaped by supply, and that's what we're looking for from the Fed, the acknowledgement of the tougher trade-off from this in this environment.
The market's on shaky ground, like you mentioned. Does, just given the potential for more negative news into year end, do you think the gains we've seen in October get unwound?
It's possible. It's possible because a lot of the bad news are really kind of starting to come together, and they have yet to be reflected in market pricing. So I talked about the Fed and the economy, but we haven't talked about earnings season. Look at the shocking kind of downside surprise of the big tech names last week. And yes, earnings forecasts are coming down, but not down enough. Next year, S&P 500, we're still talking about mid to high single-digit growth for U.S. Earnings in 2023. That is really not aligned with our expectation for a recession next year, right? So earnings needs to come down. It's not yet in the price, and I think markets will wake up to that before finding a foundation to then rally on.
For investors that are still willing to have some type of risk component in their portfolio, they might look at speculative assets that are highly kind of deteriorated from some of their peak values. And I think about crypto. BlackRock has its own kind of blockchain-based ETF as well. I believe you've launched 2 of them over the course of this year, but I guess more broadly speaking, is this still a time to be kind of looking at crypto, even though the valuations are highly depressed from where we began even at the kind of early points of the year here?
Well, with regards to crypto, there is a demand. That's why we issue the products to address that demand. But assumptions on return and risk needs to be really positive for crypto to justify even a small, very, very small allocation.
But again, that is slowing as the Fed, as we would hope. The big drag on the GDP last quarter was in housing investment. Again, that's the sector that we would think would be most sensitive and susceptible to the rate increases. The big win, or the big wind in the growth of the GDP came from net exports. We'll see how that gets revised. But overall, what this report tells us is that the economy remains robust, it remains resilient, even as we're starting to see the kinds of cooling that I believe the Fed is looking for.
Well, and that's my question. Can you have this robust a growth and get your arms around inflation at the same time? Because a lot of people are very concerned, as you know, about inflation.
Yeah, absolutely. So we also got unemployment insurance claims today that they remain low as well, suggesting that our labor market remains quite low. This is an unusual economy, and we haven't had inflation in decades, but we also haven't had this kind of economic crisis. So I believe we have to follow the data, and we obviously try to look around corners, but these data suggest to me that we are seeing the kinds of cooling that we would expect to be seeing as the Fed increases interest rates. We will see what happens going forward. We know that the global economy is fragile, but we also know that the U.S. economy is resilient, and we remain optimistic that there's a path by which the Fed can tame inflation without generating too much pain in the overall economy.
How bad is the global recession of next year?
The global economy, as you say, Tom, is looking very soft at the moment. In aggregate, our projection is 2% global growth. If you take out our relatively bullish expectation for China, we see global growth at less than 1% next year, which is right on the border of what's been traditionally associated with a global recession. Now, looking a little bit more at the details, we see early next year a fairly severe downturn in Europe, including both the euro area and the UK. And then as the year progresses, the monetary tightening in the United States leads to a recession during the second half of the year here as well. So pretty tough outlook, challenging in a lot of different respects. And that's coupled with an inflation outlook that remains very concerning.
Nathan, financial conditions have eased. With the backdrop you're talking about, financial conditions have started to ease. And that's because a lot of people are thinking about the Federal Reserve backing away from the pace of hikes, go from 75 maybe down to 50, the size down to 25. Nathan, what do you make of that conversation?
I think the Fed has struggled in its communication. It has set up, at least implicitly, a syllogism that if we are serious about inflation, then we go 75 basis points. And when rates are low, it makes sense to have that syllogism. But once you move to 3%, and in November there'll be a 3.75, as you move higher, you've got to start casting your determination and framing your determination to fight inflation in different ways. Specifically, the Fed can say we moved substantially, and that reflects our commitment. And if you don't believe that we're committed, just watch what we're going to do. So I do think they're in a tough situation where they've got to pivot. They can't take rates up at 75 basis points rate indefinitely. And the markets are interpreting that as the Fed kind of pivoting off inflation determination, which I think is a misinterpretation of where they are.
I'm looking right now at some of the GDP components. Michael McHugh is breaking them down. And we saw housing. He mentioned housing, and he just clarified that residential investment subtracted 1.37% from GDP. This is a quickly moving story. Under the hood, how much are other inflationary components offsetting some of these disinflationary moves that we're seeing in the housing market, that we're seeing in retail, that we're seeing in used car prices, that you could see on the margins around the economy?
Very clearly, we are now in a dynamic of disinflation in terms of goods prices. That is clearly happening. We expect that it's going to come off quite sharply in coming months. Similarly, the shelter prices are persistent the way they're calculated in the indexes. But when we're getting these monster declines in residential investment, that's pointing to a very soft housing market. But where the heart of inflationary pressures remains is in the non-shelter services. And that is tied to the hot labor market, rising wages, and rising services inflation. That is what the Fed's worried about. And that's what the Fed is targeting here effectively, is they've got to see more contained numbers in terms of non-shelter services price inflation. And that may yet take a while.
I look, Nathan, at how we're going to recalibrate. We're going to recalibrate off this press conference. John, what, in 4 minutes?
Something like that.
We're going to recalibrate November 2nd. Frame the Citigroup look for next year. I'm going back to your stunning global GDP call of 2% next year. What is your year opening report going to look like? Give us a heads up.
So what we're seeing at the moment, and it's looking pretty durable in my mind, we're calling next year rolling recessions in the global economy. We're going to see various countries turn down. The vast majority of GDP will see a downturn. That would particularly be accentuated and exacerbated if the Chinese economy ends up being somewhat softer, and instead of the 5.5% we're forecasting, if it's more like this year at 3.5%. And so you've got this on the growth side, and then you also have central banks that are going to have to, early in the year, continue to hike. And as the year rolls on, our expectation is hold those rates at high levels. So next year is going to be a challenging year. I'm kind of already turning the page to 2024.
나의 도전 뒤엔 늘
아들,
열렬한 지원군이 있었다.
우리 아들 화이팅! 아들 자신 있게. 아들 잘 커줘서 고마워. 아들 밥 잘 챙겨 먹어.
그런 엄마가 새로운 도전 앞에 섰다.
아들 저녁은 먹었어? 엄마도 가게 한번 차려볼까 하는데. 엄마의 오랜 꿈이었어. 아들도 응원해 줄 거지?
그땐 엄마에게 아무 대답도 못해준 아들이었지만 지금이라도 알려드리고 싶다. 지원군이 있다는 게 얼마나 든든한 일인지.
엄마! 아들!
마음이 하나로 이어집니다. 모두를 잇다. 하나증권.
Well, we had some good news on GDP, the first positive growth this year, but it may not last because the underlying components are a little weaker than expected. 2.6% annual rate of growth in the third quarter. That's up from a 0.6% in the second quarter and a negative 1.6% in the first quarter. Consumer spending dropped off, up 1.4%. That was down. Business investment a little stronger, but a big drop in structures building held that back. Change in inventories was lower. That does subtract from GDP, but net exports is lower. The trade deficit got much narrower during the month. Exports went up, imports went down, and that means that overall that adds to growth. So what is the data telling us? Consumer spending weaker, business spending held up. Trade added 2.77% to GDP on a 2.6% GDP overall. Inventory subtracted 0.7%. Real final sales, half of what they were in the second quarter. Goods versus services shows that essentially we are recovering from the pandemic because goods spending is starting to go down. Services spending is starting to go up. And John, you mentioned some of the other areas of economy we got numbers on today. They tell us something about what's going forward. Durable goods orders on a headline basis, okay, but core capital goods orders, basically business spending, down 0.7 in September, the last month of the quarter. And that suggests that business spending, which is one of the slightly bright spots in this GDP report, is going to slow down. Now the question is what happens to the labor market? Do we still need all those workers if we're not producing as much? Jobless claims not showing any change in the labor market for right now.
morning, Secretary. Thank you so much.
Thanks. It's good to be with you.
Well, first off, as I just mentioned, Secretary Blinken, thank you so much to you and your team for your time this morning. I know you're very busy. We have an on-the-record discussion this morning with the Secretary for about 30 minutes with a 10-minute Q&A. We just have one housekeeping item. Since we're not live streaming this, we are asking if you would hold your tweets, headlines, stories until we wrap the discussion, just for flow of conversation. But again, we're very much looking forward to the conversation, and thank you all for taking time to be here. So let's get started.
Thank you.
Secretary, so just this morning, Putin is overseeing some annual nuclear drills with Russian forces. How concerned are you that Russia could use a dirty bomb and blame it on the Ukraine? Blame it on Ukraine?
Look, we're concerned about two things. We're of course concerned about the rhetoric we've heard from Putin and from other Russian officials going back some weeks now over the possible use of a nuclear weapon. We're watching that very carefully. We haven't seen reason to change our own nuclear posture. But it's something that we're tracking very carefully, and we've also communicated directly and very clearly to the Russians, to President Putin, about the consequences that would flow from any use of a nuclear device. Separate and apart from that, we've seen these allegations coming from the Russians that somehow the Ukrainians are contemplating using a so-called dirty bomb, which is an utter fabrication and something that is also the height of irresponsibility coming from a nuclear power. In fact, the IAEA is now at Ukraine's invitation in Ukraine visiting, as they've done in the past, the nuclear facilities that Ukraine has. The reason this particular allegation gives us some concern is because Russia has a track record of projecting, which is to say, accusing others of doing something that they themselves have done or thinking about doing. But there again, we communicated very clearly and very directly to the Russians about trying to use this false allegation as a pretext for any kind of escalation on Russia's behalf.
And just to hold on that for a second, what would be our response if Russia does do something like that in terms of a mirroring event?
Well, I'm not going to get into speaking publicly to what we and others would do, other than to say that we've communicated that very clearly and very directly to the Russians, including President Putin.
So staying on Ukraine for a minute, a little longer, in terms of more broadly, we're heading into the midterm elections. We are hearing some concerns grow louder about support for Ukraine, the cost of it. What assurances are you giving to Ukraine and our allies that we are going to stay supportive for the months ahead?
Look, what we've seen to date is a remarkable bipartisan consensus and bipartisan support for Ukraine, for putting pressure on Russia to cease its aggression, for taking the steps necessary at NATO to shore up our own defensive alliance. I visited Ukraine, I visited the neighboring countries with bipartisan delegations from Congress, from both the House and the Senate. And that consensus, that strong core, I think remains strong and will remain so going forward. It's vitally important because it's in the national interest. Yes, of course, there's deep concern about the horrific destruction that's been done in Ukraine, the brutalization of the Ukrainian people. And that, I think, touches Americans across the board, irrespective of whether they're Republicans or Democrats, members of Congress, or citizens. But we also know that this is an aggression against the very principles that are at the heart of the international system, necessary for keeping peace and security. Principles that grew out of the experience of 2 world wars and a conviction that we had to find ways to make sure that those couldn't be repeated. And so there was an agreement that you can't simply go in and seize territory from another country, that you can't change the borders of another country by force, that you can't try to erase its independence and sovereignty from the map. And if we allow that to go unchecked, if we allow that to proceed with impunity, it opens a Pandora's box around the world for would-be aggressors. That's going to create conflict, and we know from history that draws us in. I think in my conversations with members of Congress, Republicans, Democrats, House, Senate, there's a shared conviction that this is important, it's necessary, and we're sticking with Ukraine.
So you were just referencing history a couple of times there, and I know you have written about studied, worked on foreign policy related to that intersection of the US, Europe, Russia, particularly around energy for a long time, even writing a book, Ally versus Ally, on it in the 1980s. So if you fast forward to today, what is your view on whether Europe has finally learned its lesson on energy dependence with its neighbor?
What we've seen over the last 9 or so months since the Russian aggression began is remarkable in terms of actually moving Europe away from this dependence on Russian energy that's built up over decades. Europe in general, leading countries in particular, have done more over the space of 9 months to break that dependence than anything we've seen in years. And we see that in the already dramatically reduced dependence on Russian gas, in particular, on Russian oil. And that's vitally important, and it's going to have profound strategic impacts going forward over the coming years and decades. But like any transition, especially a transition from something that's built up over so many years, it's challenging. It's not without difficulty. It's not without pain. And Europeans are facing that square on. We're working to do everything we possibly can to help, especially to get through this coming winter and the winter beyond. As you know, ever since the Russian aggression, and even going back before that, we've been working to, first of all, to make sure that there's enough energy on world markets to meet demand. We've worked very closely with Europe in particular in the short term to make sure that we could get a surge of LNG supplies, liquefied natural gas, to them to make up for what they were losing from Russia. We've worked with partners and allies in Asia to divert supplies of LNG that were going to them to Europe. We've increased our own production of oil and gas to record levels. And of course, the president has drawn down from the Strategic Petroleum Reserve in part to keep prices in check. One of the things that's happening in Europe now is because of the very important moves that they've made, including to try to decrease demand during this critical period, to pursue the transition away from Russian energy, and to take other steps. The supply that they have on hand going into the winter will probably be, what's necessary to keep things going and to keep people warm and comfortable. However, the impact on price is what's the immediate concern, because that has the potential to make it harder for industry to get the energy it needs to keep producing things. That has economic impacts, et cetera. So one of the things that we're working on, and it's something, of course, that affects our own citizens, is not only making sure that the supply is there, but making sure to the best of our ability that prices are kept in check. And this is in a moment, of course, of global inflation. So all of that are things we're working on. We're also working on the longer term with the Europeans. We established a task force with the European Union to work on this longer term transition. Last thing I'll say is that it only accentuates the need, as Europe is moving away from dependence on Russian energy, to also pursue this energy transition to renewables. That too takes time, but it only, I think, emphasizes the imperative of doing that, not only in terms of dealing with climate, but also in terms of dealing with dependencies on fossil fuels, particularly coming from specific countries like Russia.
So you just hit on a number of things there that we cover so closely here at Bloomberg: energy markets, inflation, both in the global economy and certainly in the US right now. And it's also making me think of Saudi Arabia. In terms of relations there, they seem to be at the lowest that they've been in a really long time. What can you possibly do to potentially recalibrate that relationship? Are you preparing to try and do something like that and re-engage the Crown Prince at the G20 coming up, for example?
First thing to note is this. This is a relationship that has been built over many decades, over many administrations, different leaderships in Saudi Arabia. It's been built up on a bipartisan basis, taking into account a multiplicity of interests that the United States has in that relationship, and ideally in that partnership. And as we're looking at where we're going to do it in a very deliberate fashion, in consultation with members of Congress, as the President has said, to make sure of this, that the relationship better reflects our own interests. So we're looking at how to most effectively do that. Since the decision by OPEC Plus, which we've not been, not been shy about, making very clear the extent to which we view that as a wrong decision, and one that does nothing actually to advance our interests. On the contrary, the potential were prices to go up to further line Putin's pockets at a time that he's committing this aggression, to have prices rise if they were to rise at a time when the world economies are trying to recover from COVID, as well as dealing with global inflation. So we've been very clear that this was the wrong decision. And also the wrong decision in terms of OPEC Plus itself and Saudi Arabia, because there was nothing to suggest in the analysis that we have and that we shared with the Saudis that we were looking at prices plummeting in ways that would be problematic for them. But having said that, since the decision, we've seen a few interesting things. The Saudis supported the important resolutions at the United Nations condemning Russia's aggression, particularly the resolution that went forward in the General Assembly condemning the purported annexations of Ukrainian territory. We've also seen the Saudis come forward with about $400 million in humanitarian assistance for Ukraine. So these are positive developments. They don't compensate for the decision that was made by OPEC Plus on production, but we take note of that. The other thing I'd say is this. Right now, we have actually not seen prices go up because we've taken steps, the President's taken steps, including a further release from Strategic Petroleum Reserve, additional steps on our own production that are keeping prices in check. In fact, they've actually gone down a little. And of course, the actual production cut has not gone into effect. This was an announcement of a decision. We haven't yet seen the production cuts go into effect themselves.
How much of a risk, though, do you see if energy markets in Europe really do tighten up? We see some blackouts, or even we see in places like the Northeast in the U.S. start to struggle in terms of access to energy this winter. How destabilizing could that be in terms of our support for the war in Ukraine or just the global economy?
Look, my own assessment is this, and I'm not the leading expert on this, so maybe Secretary Granholm can come by and others. But based on the steps that the Europeans have taken over the last 6 or 7 months, and particularly over the last few months, including the summer, they've done a number of things that are very significant that I think will help keep things in the right place through the course of this winter. One is to make sure that their own reserves were as full as they possibly could be, so they've done a very good job in doing that. But two was to take very significant steps to decrease demand, and that's making a difference. And three, of course, is the work that I alluded to that we've done to make sure that we could help surge to them supplies of energy that would compensate for any losses that they're getting as a result of moving away from Russian oil and gas. And so, again, on the LNG, we've surged that. We've diverted supplies that were going to Asia. We've increased our own production. All of this together, I think, is having a positive impact. And look, we'll see how things go over the coming months. There are things we can't control, like the weather. So we'll see what the winter's like. But my own assessment is that the Europeans have taken very important steps to make sure that they can get through the winter in good shape.
So let's turn to U.S.-China relations. Last week, you made some comments related to thinking that China wants to seize Taiwan on a, as you said, much faster timeline. What are you seeing that made you think that this is speeding up?